What is up, YouTube, and welcome back to another Fridge Financials video. And in today's video, we are breaking down the news that has broken out recently around new potential day trading restraints to be loosened from FINRA. So we're going to break it down here, look at some articles and some research to give you my perspective of things as per usual. So if you're excited for today's video, as always, feel free to like the video, subscribe to the channel, and turn on those bell notifications for all future uploads. Now, we're going to look at this in two different perspectives of things, so don't get me wrong here. I'll give you my take of it towards the very, very end here. And we're going to look at a bunch of different articles, what it means for us, and how it could help, how it could hurt, all these different things that go into it here. So we're going to start with the Bloomberg article, cover some things there. Actually, before we even do that, just in case you don't know about day trading and what it is, I don't have to go through the whole thing. This is from the website, the FINRA website itself, which basically just breaks down how day trading works. Basically, you have to know what a pattern day trader is. Again, it's referred to a trading strategy where an individual buys and sells, or sells and buys, the same security in a margin account on the same day. So you might hear people talk about all the time, if you buy and sell, if you enter and exit a position basically on the same day, that is considered a day trade. And the pattern day trading means that if you execute 4 or more day trades in 5 business days, I believe on Robinhood though it says 3, so maybe it's because that's the restriction there. So you're considered a pattern day trader if you do 4 or more day trades within 5 business days, provided the number of day trades represents more than 6% of your total trades in your margin account. But there's a lot of fine print here about how it works. You can look into it on Robinhood, Webull, any kind of brokerage you have. They'll break down what pattern day trading rule is basically. And the idea behind it is that they usually would like you, before this news broke out, the day traders, the pattern day traders, must have at least $25,000 in their margin account. If you have a cash account, none of this applies to you whatsoever. But if you do have a margin account, in order to be a pattern day trader, you have to have at least $25,000 in equity for it. If it falls below $25,000, then you will not be permitted to trade until it is restored to $25,000. They have margin calls to talk about, so there's a whole thing that breaks it down here into the history as to why. I don't want to go too far into it. I'm not going into the article here. So U.S. regulators are finalizing plans to replace a controversial rule that would dramatically lower a threshold for retail investors to trade equities and options more often. And just with that last part there, it already has me thinking that this is not going to go well. Retail investors and options. And we'll talk about my opinion, obviously, later on things. So the Financial Industry Regulatory Authority, which is looking to rework the pattern day trading rule that limits investors with less than $25,000 in their margin account from borrowing to trade 4 more times in a 5-day period. And a proposal being prepared for FINRA's board to eventually vote on, retail investors would need to only have $2,000 in their accounts for such trades. So basically lowering how much you need to be a pattern day trader. It's kind of what we're looking at here. Currently, when an investor with less than $25,000 exceeds the $2,000 margin in borrowing from the brokerage to make equity and option trades, FINRA classifies the investor as a pattern day trader, meaning they're prohibited from making access trades on margin. And again, I made a whole video about how margin works previously. You can take a look at that video as well. It does a really good job of breaking it down. I think about what margin is and how you can use margin safely and not blow it and then go into debt and all this crazy stuff that happens there. If the draft proposal goes forward, the 3-trade maximum would be eliminated and individual brokerages would make their own margin calculation and decisions as to the minimum balance that customers need to day trade. This right here already kind of brings me some speculation as to saying, okay, so you're letting the brokers decide what the rules are and the minimum balance that you need. So I just worry about that being a thing where say, okay, it started at $2,000. Well, say Webull says, okay, we'll do 5,000. And Robinhood says, okay, we'll do 2,000 now. The volume of people is going to flood over to these. That's going to be like it's almost going to be like a fist fight, I feel like, for who's going to be getting what and who's going to have the lowest one, right? So 2,000 is going to be obviously like the lowest you can go. If Webull says 5,000 for protection and safety reasons, obviously, because again, if people are taking out margin on their accounts, then they're loaning money out, and there's a risk of not getting it paid back to them. If Webull says 5,000, Charles Schwab says 7,000, Robinhood comes out and says 2,000, the lowest it can go. where do you think all the retail traders are probably going to go to? They're going to flock over Robinhood. So depending on how they navigate this is going to be very interesting. So I'm not sure how I feel about brokers having the decision individually about how much the balance is needed, because that could cause, that's not, is that going to be equitable? Is there going to be that kind of imbalance between brokerages, right? Who knows? The existing rule adopted in 2001 was put in place to protect investors from massive losses and borrowing more than they can cover in holdings or cash. Industry executives say that markets have evolved since, spurring FINRA to review the current requirements. Have evolved since. Yes, we have. Today, trading is often commission-free, although not in all securities, and there's less concern about excessive commission costs. This is a financial professor at Massachusetts Institute of Technology. Amazing. For this reason, I think a moderate reduction in the minimum margin for pattern day trading is fine, in the particular if the reduction applies to securities for which trading is now commission-free. And the fact that he says a moderate reduction, that's not moderate. You're going from 25,000 to 2,000, give or take, obviously, what other brokerages aside. That's not a moderate reduction. It's you want to like kind of ease it down, right? Maybe it was 25,000. How about we do like 18,000 or 20,000? Then we can go lower and see how retail responds to that. I get the point of this. I'm going to talk about the pros of this and how it works. But for me, as someone who is a retail trader, I'm classified as a retail trader, and I've talked to thousands of people online at this point from social media and stuff like that, from after hours, shout out to after hours as per usual, from after hours, YouTube, Instagram, Facebook, whoever. I don't know. I don't know how I feel about that, obviously. And again, moderate reduction, but you're going from 25,000 to 2,000. You're looking at a like 90% cut. Like reduction there. Okay. That's moderate, right? Almost the whole thing. Might as well go to zero at that point, right? I don't know. Imagine if they went to zero. Oh, good Lord. That'd be wild. As FINRA considers revising the rule, a group of retail brokerages met to discuss a draft of the proposal that is likely to be submitted to FINRA's board in the fall, according to people with knowledge of the matter. If the board approves it, then FINRA, who is a self-regulatory organization for broker-dealers, is expected to submit it to the SEC for final approval by the end of the year. So that's really good. It's SEC has the final decision of things here. FINRA can submit it, like the whole thing. Let me go from there. That's good. I'm glad the SEC oversees it still, because again, the SEC oversees securities and stuff like that. More than 50 brokerages and clients have written to FINRA, which requested comments on potential rule change in late October. If the current iteration of the proposal is sent to FINRA, it will then go to an additional comment period before progressing to the SEC. An actual rule change may take as long as a year to implement, according to people familiar with the matter. And that's good. Don't roll out right now. And this kind of brings up another point that I'm talking about here. 50 brokerages and clients have written to FINRA. We don't know who it is, which kind of stings. But, 50 brokerages and clients. Well, if it was like 48 clients and then like Robinhood and Webull and that was it. I don't know, but that's, obviously I would like to see more of the specifics for it, but we obviously do not know. So it talks about more of this no update at the time. The pattern day trade rule has been long garnered complaints from retail investors and their brokerages for being overly restricted on those of smaller accounts. The market for equity options contracts has expanded by 23% since last June. Addressing demand growth, brokerages point to improvements in their own risk management since the rule was put in place more than 2 decades ago. Any change is likely to open up the market for more retail participation given the lowering threshold. Retail participation. I'm trying to hold back my thoughts for now, just hating my 2 cents afterwards here. A study from the Stanford Graduate School of Business in 2024 found increasing market access will likely impair retail investors' performance. Outside the U.S., regulators have flagged their own concerns. The Securities and Exchange Board of India study released this month found that 91% of retail investors report losses from trading equity derivatives, like options and that kind of stuff. 91% of retail investors are reporting losses. And you want to sit here and just be like, Let's make it more accessible. Why not? 91% report losses. Day trading on a margin account is risky. That's why they put this rule in place. Yep. Completely agree. 91% is absolutely wild, obviously. I think that it's usually people always say it's like 90% of day traders lose or fail to outperform the market, whatever the case is. 91% report losses from trading derivatives. That is wild. This talks about options and everything else. Option trading has soared as tariff-related uncertainty has yet to abate, seeking quick returns. Gambling. Retail traders have been buying the dip, taking risky bets on price moves comparable to those made during the meme stock craze that started in 2020. At that time, traders sitting at home funneled their money into equities such as GameStop and AMC with little concern for company performance, and many investors lost substantial amounts of money. Except for, obviously, Roaring Kitty, obviously. And it's just like the video I made yesterday about Open Door. And I saw, Kohl's pumped pre-market almost 100%, then dumped right after like 60% from the highs. I saw Krispy Kreme is running. The meme stocks and the short squeezes and everything. This is, oh my God, I don't know. Robinhood was criticized for that. We already know that. Some brokers and retailer traders now see the PDT rule as an antiquated relic of the dot-com bubble, when greater protections were deemed necessary to mitigate risks. Sure. Brokerages including Robinhood, Fidelity, and tastytrade wrote in their comment letters to FINRA that improved monitoring of trades makes it easier for customers to avoid margin calls. And I would love to see the data about the number of people that get margin called, like over the years. I would be curious to see that. And again, margin call is when an account is frozen until you can get your balance restored. Now, the introduction of zero commission fees has lowered costs and eased financial risk. Okay. Brokers currently reject trades if an account has insufficient buying power and tracks the client's positions. Okay, well, that's definitely true. They do monitor that, which is great. That they're like, hey, you can't do this. I think the balance requirement should be ended entirely, said Colin Baker, 23, who graduated from Carleton College in June with a degree in computer science. At 18, he was unable to trade options due to the rule, and instead ended up trading riskier products such as futures, ultimately blowing up his account. Okay. It's a pointless bear if you want to figure out how to trade. And so this is kind of the major argument, right? The major argument for people saying get rid of this rule here is that, hey, like, I don't want to have to trade super risky things in terms of futures or have to have a lot of money into my account and then lose it all. I want to just practice day trading with like a couple $1,000s. If I can day trade a couple $1,000s, I blow the account. It's a couple thousand compared to 10s, 20s, 30s. Because usually how the mind works is that when you see a lot of money in a portfolio, you're probably going to be thinking like, oh, I just lost like $1,000. Okay, let me use 2,000, get it back. Okay, I just lost that one. Let me use 4,000. You know what I mean? Like when you have a bigger account, you're more likely to probably spend more of it as a result. Just like when you look at a bank account and you have a lot of money in there, people like to spend more as a result. So if you're able to day trade with say $2,000 and you blow the $2,000, then you say, okay, let me sit back, let me refresh a little bit, let me do some more research and expectations, and then go back in again at smaller chunks. So that's basically what the argument is for the pro side. And it makes sense, obviously. See if there's anything else to really talk about the barriers still. Clients have opened additional margin accounts at multiple brokerages to work around the rule, leading brokerages to view it as ineffective. Of course, people always try to find a way around it, because why wouldn't they, If you want people to trade options well and not gamble, they have to learn how to trade. And that's just a cool statement, I guess. Like, why not? Sure. So that's kind of what we're talking about here. And so this other article breaks down what it could mean, stuff like that. We can go into the idea here. Again, I'm going to get rid of the 3-day trade limit over 5 days, allow them to set their own minimum thresholds, and reduce the trading from 25,000 down to 2,000 at a minimum, right? And again, everybody brings up the meme stock trading frenzy. The same data gets pulled out here. Some good open questions, though, is will FINRA update the PDT classification itself? So are they going to update the rules or just let brokers do whatever they want and just get rid of it entirely? How will they do individualized minimums and ensure compliance? And will it apply equally to options and equities? retrades and what protections will exist for novice traders. So some good questions to think about really as we're looking at here, as we're trading more and more, all that kind of good stuff. And so this one kind of talks about, this article is AIinvest.com. So it has a lot of AI uses of tools here in this case. But what I think this little section here makes some good point. It makes a great point. This is going to go one of two ways. People are going to just trade and trade and trade and just trade more capital, trade more cash and all that stuff without really learning. Or they will use this time to prioritize their learning and to educate themselves about risk management, about position size, about, entries, exit points, charting, patterns. Like, either you use this time now if this goes through, you use that time to then start to educate and do a lot of research, and then you can become a better trader and you can trade with less money. Or you just start yellowing everything in and blowing the accounts left, right, and center, and it doesn't matter. And here's what people say also, as another argument that I forgot to mention. People say that what really sucks is that, like, to avoid a day trade, people might hold their securities, they might hold their positions overnight. And what that means is that if they're holding them overnight, there's a potential for them to have some loss in the following day in the market, because you have overnight traders, you have the dark pools that trade things and stuff like that. And you might be up, $400 in this trade today, but you can't close it because of the pattern day trade rule. So then you hold it overnight and then you're down $300 next morning because news comes out or someone shorts the stock or whatever the possibility is as a result. So that kind of sucks that, like, we are limited because we have to hold our trades longer than major institutions. So that was also another major argument I saw people talking about here, was that. And it makes sense. I get it. What prioritizing education is, this is where it really is going to boil down to, is this going to be a good idea or not? Or are we going to just keep throwing money into YOLO options, meme stocks, short squeezes with a lot less capital required? That's my fear. And what this is going to do is this is going to push a lot of volatility into the market. This is going to push so much more money into it. And people are saying, well, what's the, who does this really benefit? Well, again, if there's more cash being put in to the markets, that gives you, the retail trader, a chance to make money, but it also gives the major hedge funds and institutions the ability to use you as exit liquidity and to basically take your money out and take all your funds, because they'll pull the stock off from underneath. Because again, they still have millions of dollars of cash to be able to control markets more than we do. So it puts more money into the market, but you could still be taking those huge losses because, again, you have hedge funds and institutions that are managing these and everything else. And then who is the one who will ultimately benefit from this? And what my opinion is on this is kind of getting to my opinion here. The people who will benefit from this are the 9% of retail traders who don't lose, because as we talked about before, 91% lose. So they're going to be great. They're going to love it. That small percentage of people. The 91% of people are going to blow their money. They're still going to lose money, whatever the case is. But you know who really will make a lot of money? Brokerage accounts, brokerage firms. They are the ones who are making money. Why is that? Robinhood gets paid when you swipe. The minute you swipe and your order gets filled, they get a rebate from their market maker, the person who matches the buyer and the seller together, and then Robinhood takes a small percent from the difference in those in the spread, right? So they have a spread of money, essentially. Robinhood takes a small commission from it every single time. If you reduce the pattern day trade rule from 25,000 cash to 2,000, understand how many more people are going to be swiping. So many more. Open, close, open, close. Open the trade, close the trade. Open the stock, close the stock. Open the option, close the option. Every swipe you do on these brokerage accounts, these brokers are making cash from the filling with the market makers and everything else, and getting the rebate from it. So to me, this would be a phenomenal idea for brokerage accounts, which is why, from that business perspective, of course they went to the FINRA and were like, hey, can you reduce this? Because it allows a lot more swiping. Because if you have $5,000, maybe you're swiping, once every couple of days and swing trading, but now you're swiping every single day. I don't know. That's going to be some good money coming in for those brokerage accounts here, right? So it's something to think about as we talk about more and more. But again, it's going to go one of two ways. This is either going to be great for retail. They're going to do the education. They're going to do the research. They're going to research, and backtest, or they're going to just keep day trading things. And I hate to say it, from my perspective as a retail trader, I do not know how much this will happen. And here's my reasoning as to why. Zero DTE options, which is literally gambling because it stands for 0 days to expiration. So today, if I open up an option today, it would expire today at 4 p.m. It only is open for a day. Look at the increase of zero DTE options volumes here. The green right here is your, I know it's kind of hard to see, but your green is your zero DTE. The blue is the non-ones. Zero DTE, literally considered gambling, in my opinion, has had such an increase in over time. And it's only going to continue because people are chasing that next thing. They're chasing those gains because zero DTEs, there's so much volatility baked into these options here that even a 0.5% move makes you hundreds of dollars, but also can make you lose a lot of money as a result for it. And zero DTE is coming up. And if that doesn't make it worse, look at the retail versus institutional shares of zero DTE options trading. Red is retail, blue is institutional. Since April of 2024 till April of this year, this is recent data. This is not like 10-year-old data here. Retail is always trading a lot more zero DTE than institutions. This is probably one of the reasons why institutions make a lot more money than retail, because the volume, the percent here, 55% compared to 45% or so, like that's insanity. Retail loses the long run to the institutions here. And it's been a fact for years. And, the other thing that I'm thinking about is study reveals that surging gambling addiction follows legalization of sports betting. You're giving people access to more trading, and trading can be considered gambling depending on how you do it. And a lot of people blow accounts and they do this. And again, 91% of traders lose money here. It's almost literally gambling. And when you've increased sports betting, the amount of gambling, look at how much money we have here, right? So the number of states has grown, obviously, which is really, really nice there. How much is wagered has gone from 4.9 billion to 121 billion in 2023. And it's online. It's not public, or it's not in person. It's online, right? Record numbers of gambling addiction help. Internet searches for help with gambling addiction, such as I am addicted to gambling, have cumulatively increased 23% since June of 2024. The gambling addictions has increased. Zero DTE options, again, gambling. Reducing pattern day trading to 2,000 is going to bring out a lot more gambling, I feel like. And that's going to be terrifying to see. And I don't like that as much. So it's insane. The introduction of retail sportsbook led to a 33% increase in gambling addiction help seeking searches during the 5 months before online sports betting was launched. When online became available, searches surged 61%. So this is kind of where I feel like we're going to go to right now. And again, as this is my perspective and everybody's entitled to their own. Again, the pros behind it, yeah, you get more chances to trade day trade options, stuff like that. And just so that only the wealthy are able to day trade options. You get stuck with pattern day trading rules and stuff like that. But again, if 91% of retailers report losses reducing it to 2,000 gives even more retail traders availability to trade, and who knows what will happen to the results. So I honestly, going back up to here, right here, I'm not a fan of this. I'm not. I can't say I am. I'm really not. I know like casinos and like even like gambling websites that they put those restriction things on there, like, oh, you can only spend $10 a day or $100 a day gambling, whatever. And people still gamble at this no tomorrow, and there's a lot of risk there. And I feel like this is going to be leading the same way here. So I'm really nervous here personally. Obviously, again, if you're a professional day trader, this is amazing. If you're profitable for many, many years, of course, this is amazing. But for the average retail trader who likes to buy into Open Door, who likes to get into what's another one that was here? I saw another one that was trending here recently. Open Door was trending. Krispy Kreme trending, Kohl's trending, Rocket Mortgage, which is also trying to get a short squeeze going. Like these stocks right here, this is where retail is going to. GameStop, AMC from years ago, that's where they're going to. It's not financially investing for the future. It is taking money and gambling it. So thank you guys so much for watching today's video. I know it's a longer video here, and I appreciate if you sat through the whole thing. Please, again, hopefully this gives you some knowledge and some insight as to where I'm looking at this from a perspective here as someone who is a retail trader. I do hope you make money in the market somehow, and please be responsible with your trading. And as always, I will see you guys in the next video.